Guys, our Super Bowl of the week, Apple, Google, Amazon. Amazon first. They reported 3 cents per share, $300 million in profit versus expected of, depending on who you look at, 15 or 17 cents per share. They missed big. They crushed on revenue. But remember what we said. Their goal, they said, at the end of in the third quarter of last year, they said, our goal for the fourth quarter is to break even. So they beat their goal, but people were still expecting higher.
Correct.
Amazon's currently down 3.5% after hours. It was down 6% at one point. They beat on revenue, 149 and change billion versus 145 and change. So they beat on that. Now, I want to remind everybody, look at Amazon's 5-year PE. This is why we have it on our software. We want you to be able to look at the long term. The 1-year PE is egregious at 93. The 5-year is still egregious at 70. Their return on invested capital. This is what Charlie Munger and Warren Buffett love. It's low. It's 8.9% over the last 5 years, and last year's is 3.5%. You should pay a premium for companies that are growing fast and or have a high return on invested capital. Mo, what else are you reading out there? Anything else?
I'm looking at the guidance going forward.
Okay.
Net sales are expected to be between 121 and 126 billion in the first quarter. That's growth of 4 and 8% compared to the first quarter of last year. Okay. Now this is funny. Operating income is expected to be between $0 and $4 billion.
And this is off their website, isn't it?
Yes, right off their website. Compared to 3.7
No, it's
billion.
about Amazon. Is it about Amazon, their website?
This is Amazon's
Investor Relations?
Investor Relations.
Oh, wow. Okay.
Yep. So operating income between 0 and 4 billion compared with 3.7 billion in the first quarter of 2022. So
hey guys, cool. I'm going to make an announcement for my company. This year we will differ between going bankrupt and becoming billionaires. It'll be somewhere in there. I just don't know where it's going to be, but that's my guidance. By the way, I'm being funny and it's not quite the same, but anyways, Amazon was at 188 on July 13th, 2021. Go look at our last Amazon videos. Go look at the comments. Amazon's not going to fall in half. You guys are idiots. We're like, yeah, it needs to fall more than half. Just earlier this month, it was at $88 a share, $81 a share.
Yeah.
The 52-week low.
$81 a share.
On January 6th of this year.
It's amazing.
Anniversary for all you crazy Trumpers out there. That was a big anniversary for you guys. See what I did there? See what I did there, Nick? Nick laughed. 81.44. And by the way, I'm not a lib. I'm libertarian. But guys, gross profit of 13% for Amazon. This is like a car company. If you gave me all these stats, I would say this is a car company. If we did one of our blind, what's it called? Stock analysis. I'd say it's a car company. All right, let's see what analysts expect for, let's look at the 8 pillars here.
Yeah. It's probably not pretty.
Red, green. Oh, boy. Their cash flow growth has plummeted. $40 billion less than cash flow, but I'll tell you why.
They love diluting their shareholders.
Of course they do. So guys, free cash flow is cash from operations less your capital expenditures. This is the true lifeblood of the business. 5 things you can do with it. Buy back shares, pay dividends, pay down debt, make acquisitions, and invest back in yourself. Look at their capital expenditure growth in the last 4 or 5 years. 13.3, 15.3, 30.6, 57, 66 billion. That's going to affect their cash flow, of course. Big time drop in cash flow, but it's also going to affect their net income because even though these aren't in the net income immediately, they get depreciated. And so down the road for 5 to 7 years, it's going to depreciate and show a lower net income. But these analysts know this and they're guided on this by the company. So the fact they still missed, don't make your excuses for Amazon, please. It's still an expensive company.
Man, they love making acquisitions too.
Do they?
Yeah. Well, we'll see what happens with Andy Jassy, I think is the new CEO's name. He's really all about cost cutting and this and that. So we'll see what that actually means. Cost cutting to Amazon is a lot different than
our girlfriend.
You and me.
Our girlfriend Kathy Wood thinks that Amazon will be all robots within the next, which I didn't think was egregious, within the next 7 years.
That's probably the smartest thing she's ever said.
Which isn't saying much. So this year they're expected to make $1.72 by the 51 analysts in our software that are analyzing them. And then look at this. In 3 years, they're expected to make $20 a share. Okay. So 20 times 15 is $300 a share. Okay, maybe. If it hits that, it's going to be a very valuable company. Let's go see what Amazon is worth to us. Let's go to our stock analyzer tool. Mo, you do a 10-year analysis. I'll do a 20-year. Now, guys, stick with us here because we still need to do Google and we still need to do Apple. Google has reported. Apple, we're waiting about 13 more minutes for. So we're going to do our stock analyzer tool. It'll show you what to pay for the company, not including their balance sheet. check this out. Our software's here. You guys know all about it. It's a great way to understand, go into the community. I guarantee I have a lot of conversations happening right now in the community about Amazon and things like that. So, Mo, you're doing a 10-year analysis?
Yeah, this is hard. And I think it's hard because I just looked at the income statement at the revenue. That revenue I don't think it's sustainable. I even looked at the analyst estimates going forward. I'm like, how is that sustainable? Let's see. I actually don't like doing this. This is hard.
It's very difficult.
Because I look at this and say, yeah, that could be a little bit low. That could be a little bit high. But I actually don't know.
Yeah, all of these that's the thing about investing. It's an art, not a science.
I'm telling you right now, looking at this, I'm basically saying I'm moving on from this one.
Yeah, it's not obvious to me because look at the difference between free cash flow and earnings. Now I hit the analyze button. I'm going to go to my 20-year analysis first. I did 4, 6, and 8. Mo, what'd you do?
I did 6, 9, and 12.
Okay.
I mean, if they low end 6, I think they need to normalize. And remember, this is 10 years. If they crush it over.
And mine's 20 years.
Yeah. So
profit margin. I did 2.5, 4, 5.5.
I did 2.5, 3.5, 4.5.
Okay.
Same for free cash flow margin.
I did 2, 3, 4 for cash flow margin.
Yeah, even though it's not the same.
PE.
14, 16, 18.
15, 16, 17. Now, for those of you who look at this 101 and say that 15 is too low, what you're saying is, if this iPhone, I started at $100,000, but then lowered to 50, you think it's a good deal, even though you can buy it in the market for $1,200. Mm-hmm. Just because something is a discount from where it should be doesn't mean it's a good value. Right. 100 doesn't mean that 50 times earnings, like that Meet Kevin idiot thinks it is. So if you want to be dumb like him, dye your hair green, go get a DUI, run for governor of California. All right. I did 15, 16, 17, you did 14. And what did you do for desired return?
11, 13, 15.
I did 12.5, 15, 17.5. Because I still think I'm uncomfortable about Amazon and their ability to make money, apart from AWS. Yeah. Hit the analyze button. It's on my watch list at 60.
Same.
Oh my gosh.
Oh my God.
12 to 15, 25 to 30, 18 to 25.
Mine's 20, 28, and call it 50.
So guys, I want to show you something. 10% return would basically be what I think the company is worth if it's giving me a 10% return. So today, I think the company is worth 16 to 20, 55 to 75, 30 to 40, based on like literally these numbers I've put above.
Yeah, my high end is 71.
My high end 75.
Putting in a 10% return.
And it's currently at 112. It's clearly overvalued.
Yep.
Could you argue these a little bit higher? Sure. But how do you get from 75 to 112? Mm-hmm. And I'm making quite assumptions. I'm making assumptions. They do 8% a year in revenue growth. What did they do this last year in revenue?
Give me 1 second here. They did $502.2 billion.
That would take their revenue to $2.3 trillion in 20 years. Is it possible? Yeah. Sure.
Yeah.
But a lot of things have to happen. 8% growth, maybe. So we'll see. All right, Google. Google just reported. Can we verify those? Did we verify those numbers on Google?
Let me check it. And by the way, Amazon is now down 6.5%.
Oh, wow. Is it really?
Yeah. So
I can't believe all the companies I shorted today did not short Amazon. I totally forgot. All right. So it's given up almost all of its gains from the regular market day.
Really?
Yeah.
That's nice.
So Google, I think estimates were for $1.18 a share.
I have $1.15, but
okay. And the revenue was 76.53 estimate.
76.51, but
they reported $1.05.
Yep, that's accurate.
And they reported 76.01. So they missed both top and bottom.
That's correct.
Okay, let's see how Google's doing after hours in our software. Down 6.5%. Down $7. Now Google is not as egregious as Amazon. The 5-year PE is 31. The 1-year PE is 20. Look at this amazing free cash flow. Look at this amazing 5-year return on invested capital.
Like this.
Look at this little debt here. 1.4 trillion market cap, 1.48 trillion enterprise value. The difference is essentially their debt. Very low debt levels.
Yep.
A lot of cash on hand.
I like these 8 pillars.
This is a very, very different company than Amazon.
This just shows me little overvalued, maybe not. I mean, I bet you there's an argument that could be made that you could pay today's price.
There probably is an argument to be made. There. So we look at this going, okay, everything else is a check mark. Google and Amazon are very different businesses in the sense of fundamentally. Look at Amazon. Their gross margin is 12%. Google's bottom line margin is 23. Their gross is 56% gross margin. That means every dollar they sell, 56 cents goes to, can cover overhead and taxes, income taxes. So what's the analyst estimates say? Analyst estimates call for $5.39 this year in profit, going up to $9.73 in the next 4 or 5 years, and revenue of $315 this year, going up high single digits to $470 a year in a few years. So stock analyzer tool. Mo, are you going to do your 10 years?
Yep, let's do the 10 year.
I'll do 20. Now, I love their ad business, but they're being attacked on their ad business.
They are. Let's see.
Profit margin.
Let's see. Oh, that is very stable free cash. Everything is stable.
I know.
It's a great company.
I know. I'm willing to pay a higher premium because their balance sheet's so good. Let's go.
That might even be a little bit high, but
let's go.
This is not on my watch list because it's triggered so many times.
I just changed it to go lower.
Yeah.
All right. For my 20-year analysis, I did 5, 8, and 11% revenue growth. What'd you do?
I did 5, 7, and 9.
Oh, I did. Okay.
You did higher.
Profit margin, I did 21, 24, 27.
21, 23, 25.
Okay. Free cash flow margin, I did 21, 24, 27.
21, 23, 25.
PE, 15, 16 and a half, 18.
15, 17, 19.
Love it. 15, 16 and a half, 18 for price of free cash flow.
Yep. Same. 15,
11,
17.
13, 15 for my desired return.
Same here.
Now, guys, I want you guys, before I hit the analyze, I beat this up pretty hard here, so I don't need as big a return. I could actually justify doing 10% here. Just, hey, if it goes this poorly, I'm okay making 10% return because that's pretty solid.
I'd be shocked if they did less than 5% revenue.
That's the thing.
So
I hit the analyze button. They're on my watch list for $85. And look, low price of 75, high price of 133, middle price of 101. And that's assuming margin of safety in there. That's why I put these higher numbers in.
I have 73 on the low end, $100.50 on the high end, and $86 in the middle.
So my 85 price is looking. Now, I'm going to put 10% in here because if these numbers have to be correct, this is what intrinsic value, in my opinion, would be worth when I put 10% in for my desired return. Look, 85 low side, 145 if my middle assumptions are correct, 250 if my high assumptions are correct. That's a big number, guys. So my high numbers come. If somebody came down right now and said, Paul, this is what Google's going to do for the next 20 years, I would gladly buy it all day long today.
Yeah.
Gladly.
Yep.
So that's the key there. That's why you have margin of safety. All right. Apple, we're about 5 minutes away from Apple reporting. So guys, I want you guys to remember, go back to Google. Go back to our videos on Google. People wrote, Google's never going to fall in half. Guys, let's look at these charts. Companies fall all the time.
Just because a company goes up a lot doesn't mean that it can't come back down.
In fact, I make the argument that the more it goes up irrationally, the more likely it's to fall.
Absolutely.
149 was the 52-week high, all-time high. February 2nd, actually yesterday, a year from yesterday, was 152. The low, November 3rd, $83. Tesla was November 4th low. Guys, we saw today, I added more shorts to my account today. I shorted using options, several big names. Not going to get into which ones they are, but I thought today was an irrational day. Completely irrational. How's Google doing? Now 4.5% down. What was it before? It was like 6% down, wasn't it? Yeah.
Yeah.
How's our Amazon people doing?
Amazon looks like it's down about 4.5% right now.
It is.
Just notable mention here, Starbucks missed on top and bottom line.
Oh boy. Let's see what they're doing. I'm gonna
Qualcomm missed on revenue, beat on earnings per share.
What did Ford do? Ford down 6.5% after hours. So Ford was expected to make 62 cents per share, and revenue of 40.6. What did they report, Tim? So this is what we do, guys. We try to, on earnings weeks and things like that, we love doing this because right now it's 4:27 p.m. Eastern time. You're probably going to see this video before. 51 cents, missing 62. Yep, 51 cents versus accurate. 62.
Yep.
Oh, so they beat on revenue, 44 billion versus 40.6, but they lost on EPS. So Meta missed on. I was going to say, Meta yesterday missed on EPS, and then they went up 28% at one point today. What's Meta doing after hours?
Meta's doing after, because this might pull Meta down a little bit, down 1.23% right now.
Mode in technicals, shorted Meta today because of technicals. Yep. And I think you shorted at 195?
191.
191. Okay, so good for you.
Yep.
All right, so let's go to anything on Apple yet? No, we got 2 more minutes.
Yeah, a couple more minutes on Apple.
Starbucks is down 3.5%. Guys, if you're new to this channel, this is the very big key you understand. The reason we use this software is it allows us to, first off, in the community, take our emotions out of investing. My brother was upstairs today crying about investments. And I was like, Mikey, relax. You have to take the emotion out of it. If you're buying if you like a company at 150, if you really think it's a good value at 150, if it falls to 100, don't get caught up in the emotion of the market, If it's worth it at 100, you keep buying.
Mm-hmm.
That's the key. Because remember, every single day, Mr. Market tells you what they want to pay you for a stock or what they want to sell you a stock for. It's your decision to decide if he's having a good day or a bad day.
He told us it was a lot today.
Yes, he told us today, oh my God, things were great.
If you want to get into the community, we are running a special right now. We do not run specials, but $7 for 7 days. Come and try it out.
It's a trial thing. That's the whole point.
$7 for 7 days. You get into the community. You get the stock analyzer tool. You get everything that we've talked about. $7 for 7 days. Come and try it out. You got nothing to lose.
Come on, Apple.
So we have 50 seconds left before Apple is supposed to report, and we will see.
Big news. Big news.
What is it?
Vanessa Hudgens gets engaged to MLB's Cole Tucker.
I don't know who either one of those are.
TMZ just reported. 96% of our viewers are men. So do you love TMZ? I'm going to say no. I mean, I do love TMZ. I love TMZ's app.
I think TMZ is probably the most credible. Look at this.
Yeah.
They got a countdown going on here on CNBC. I love when they do the countdowns.
I've never seen the count. I don't watch CNBC.
No, it's incredible. You'd think that, I don't know.
Why don't I watch CNBC?
Because they're morons.
Well, no, because it's too in the moment. It's like, oh, what's going on right now? What's going on right now? I don't care. I care about buying a good fundamental business at a great price. And I look at Google. It's a great business. Amazon, I'm going to be one of the few people out there that says, I don't like the business. I just don't think they know how to make money yet consistently. I'll wait until that happens.
Or if it ever happens.
Maybe not. Now, they spend a lot of money growing, and I get that. But at some point, I want to see consistent cash flow. I don't see that with Amazon. I see it with Google. I see it with Meta. Even Meta, and they're spending tons of money on. Did you see they spent $13.7 billion last year on the metaverse?
No.
13.7 billion. That's a lot of money. And by the way, they got revenues of like 600 million on it or 350 million on it.
It's like his little pet project that he's just playing.
But it's not a pet project. If he's right and it's the future.
Listen, I use the Oculus that I have multiple times per week. It's really fun. I mean, I do see, like, I hate doing cardio. So I'll put on an exercise class and just move around and do stuff.
Let's hear it.
He just jumped. Okay.
$1.88, missing expectations of $1.94.
$1.88, missing expectations of $1.94, and revenue was expected to be $121 billion.
And it's 117.2.
Oh no, they missed on both top and bottom.
That's rare.
They're down 3% after hours. Let's go check this out.
Super rare for Apple.
Oh, it's down 5% now.
Let's see.
Oh boy.
Tim, you got your wish.
Guys, Apple, this is the big one. It missed 6 cents per share by 6 cents per share. Missed on. Guys, this is the point. 5 years ago, probably everybody said Apple cannot be touched. It'll never end. It's going to be the best thing ever. Eventually, something will happen that'll cause it to. Listen, companies can't grow forever. Companies can't beat forever. I mean, all right, let's check out Apple. But I will say this about Apple. Look at their 8 pillars. Yeah. Look at this return on invested capital, Mo. 39%.
Yeah, that's pretty awesome.
I believe Warren Buffett's buying Apple sub 140. There's no other. I'm just doing it based on the timing of his purchases and when things happen. But I think 140 is his price, and I don't buy it. I'm not buying it at 140. I want a lower price than that. I don't think it's worth 140. But I also don't have Warren Buffett's money, and I think he has to be a lot more liberal with his spending and his ideology. But look at this gross profit versus profit margin. It's very close. 43%. By the way, Tim, we should add a 5-year gross margin in here. Can you add that in there?
This is something I like to see. We set an all-time revenue record for the service business at $20.8 billion.
That's going to be a very, very high gross margin business.
I love that they're growing that side.
That was for the entire year or the quarter?
That had to be the quarter. Had to be the quarter. Yeah, that had to be the quarter.
Okay. Yeah, it was the quarter. All right. Down only 3.2%. Analysts. Guys, look at this growth in EPS. It's not much. 636 to 884 over the next 4 years. That's not a lot of growth. Revenue, that's what? Mid-single digit growth. Revenue, same thing. 413 to 563, mid to high single digits. It's not a ton. It's Apple. They're huge.
Yeah.
They do a lot of revenue. They did $394 billion in revenue in the last 12 months. Let's go to Stock Analyzer tool. Let's go. I'm going to do my 20 years. Mo's going to do his 10. So let's go and see how it's going to grow from here. All right. Services business hopefully gets better.
Yeah.
Okay. See, this is what I like about the Stock Analyzer tool, guys. I can put my assumptions in and go in and see what has to happen for these things. Like, well, the point is about the Stock Analyzer tool, by the way, it was used over 1.3 million times by our users last year. 1.3 million. It's the most popular part of our software because it allows people to make their assumptions about the future and determine what the cash flow and will be of the business for the future. Yep. Mo.
Yes.
What did you do for revenue growth?
5, 8, and 11.
I did 4, 6.5, and 9 for 20 years. He did it for 10. Yeah. What did you do for profit margin?
21, 24, and 27.
I did 22, 24, 26.
Okay.
Free cash flow.
21, 24, and 27.
I did 24, 27. You know what? I'm gonna change mine. I'm gonna go 23, 25,
Okay.
27.
Okay.
PE.
14, 16, and 18.
I did 15, 16.5, and 18. Same with price of free cash flow.
Same here.
And your returns?
11, 13, and 15.
Same with me.
Okay. Let's
My
see.
prices. 80 to 120, middle price around 100.
Mine's 80 to 138, middle price around 106. On my watch list at 130.
So let me put 10% in here to see what I really think based on these numbers that the company's worth. And I have a low price of around 90, a high price of around 200 to 210. That's with zero margin of safety, 135 to 140.
Yeah.
This is probably why
Buffett's at it.
Buffett's at 140.
Yep.
Because he doesn't need margin of safety on his investment
Right.
now.
I have 85 to 200, middle ground about 132.
All right, guys, if you like this video is going to be out shortly. Mo and I have to go see Chris DiStefano tonight in Cleveland.
Yes, we do.
He is awesome. He's hilarious. Please sign up for our software, everythingmoney.com. 7 days, $7 trial. We love it. Thank you very much, guys. Enjoy yourself. Please subscribe to the channel.